Hi, everyone. Good evening. Uh, and welcome to Forex Expo. Myself, Sai Mahesh from ICM. So, like today, we can going to see today, which is action to achieve the goals. So, here the goals we're talking about today. It's about a general talking about the trading strategy. So, how many are traders here? Like, almost everyone is trader. Good. So basically, today is a trading strategy talking about on objectives, what exactly to be. So here the goals majorly like, it's kind of process. We can say not only the result. Because when you say many kind of traders, many traders normally focus into about the numbers, basically. Because numbers only they look. Okay, I'm a trader, I want to look into the numbers. But for example, like I will make 1% per day from the X capital, or I'll make like 20-30% per year. So just like other business, to become a trader, the more focus is like the solid process. That's most important thing. Maybe many traders here, so maybe they have faced this kind of trading difficulties while going trading on the online. So basically, like even the trading also is not different because any business needs some quite bit of time to make profit, become a profit to make it before. So same here. So understanding into the roles about the markets, a deep knowledge about the markets, as well as developing a proper process, it gives you knowledge about how to start the trades. So exactly today, what we're going to see how the process is going to be, and how you're going to start the trade, and how you're going to present into the market, what are the difficulties you face. That's the most important thing we are going to look into today. And if you see, so here are the three important goals, or I can say it's a process. So one, you can say trading strategy. Next is money management. Then the last one is psychology, challenges. Money management, nothing but the risk management. So these are the three tools to a trader to have to look into it in a very proper way. But these are the process. Some traders will have very good knowledge about trading strategy. They have very good plans. They would have very good kind of information about the markets, getting update of the markets. But they are not good in risk management. They don't know how to handle the fund. They don't know how to manage the money. How much time, how much lot, how many exposure I'll be taking. This also a problem for any traders. Some traders will have good knowledge about the strategy, some about the risk management, very perfect, but still psychology, we all human beings. Obviously, we have faced a lot of ups and downs. We always face this kind of ups and downs on your mind, whether I go right, whether this is right or wrong. Many things comes out. So let's have a look one by one. It's quite interesting topic. Same time, it will be more useful and you'll be facing everyday, day-to-day life on your trading. So talking about the trading strategy. So here, trading plan. So trading plan, it's a key pillar for being a successful forex trading. So basically, it's one of the major important things. Without the trading plan, we can't able to get you a proper trading structures, what exactly you're going to trade. So a trading plan must include all the aspects of your trading. It should cover your personalities, expectations, goals, risk management, and trading systems or strategy. So let's start with the beginning. As you are, what kind of trader you are. For example, you create a strategy. First, you have to select type of trade you are. Basically, you are a day trader, or a swing trader, or you are an investor. So what I mean, a day trader, or a swing trader, or maybe a position trader. So for you, which market you choose? That's most important things. Some may be very good knowledge in the currencies markets. Some may good in the stock markets. Some may good in commodities markets. But you have to choose yourself, first of all, which market you choose to suit you for your money management. And you have to get more knowledge about that. So keeping that on a parallel, First, a trading style also be fixed because, as I said, what kind of trader you are. When I'm talking about a position trader, normally they trade on 3 days per month. That means they're looking for a long-term trade, long-term trading sessions. So expectational returns will be around 200 to 300 pips in currencies. And again, the duration will be like week to months. This is the position trading. Those who are looking for the position trading. Obviously, there'll be more risk involved because you wait for a longer time and to wait for the profits. Moreover, you wait for the more pips to get on the markets. So when talking of the swing trade, it's normally trades like 3 to 5 days of per week, which is 50 to 150 pips per trade, and days for weeks. So it's kind of a midterm trade where you look into a kind of day chart or maybe below the day charts where you get some days like 3 days, 5 days or week time to book your profits. A quite little bit risk trader because the position trade is more risk than compared to the swing trade. When you're talking about the day trade, which is 3 to 5 days of trades, which is almost gives you 10 to 15 pips trading, which is max of 1 day trading. Normally, that's you took the execution in the morning, you try to close before the market close. So this is normally case. And again, the scalping, you know that it's a keep on moving on ups and downs, and every 5 minutes, 1 minute charts, 10 minutes. So they try to take n number of trades, like 10 to 20 trades. They try to capture like 1 to 10 pips. It comes in seconds or minutes something. So now the point is that which kind of trader you are, basically. For example, many traders like, I want to trade a position trader. But no, I'll come back to the bottom one. I want to be a day trader. No, I don't have time. I have work. I have business. So I start the trade in the morning. I try to end my trade by the end of the day. But unfortunately, they moved on to the next day. What happens here? You're coming out from your plan. That means you're coming out from your entire plan structure. That means a scalper or a day trader become as a swing trader now. So what happened? Your risk factor is going to be increased. For example, a day trader risk is something about 20 pips or 30 pips. Later on, if you move to the next day, what happened? Your risk is going to be more higher because you have waited for one more day, next day, and you become as a swing trader. So obviously, they keep moving. Again, you'll move on for the next week. Again, you become a position trader. But as your position trader, normally you will have the more risk compared to the day trader. So this way, many traders do their mistakes. You have to correct the mistakes from here. So as a day trader, you have to stick on the day trading. It's plus or minus, whatever may be, you have to cover your position the same day because every day the market opens and will close with different factors. We don't know, like market today close at some point and tomorrow market may move ups or open close or open high. So it's a very risky for the trader, those who are trade trader. But coming to the swing trader or day trader, position traders, it's fine for them because they already want to wait for a week or maybe for a couple of days or a week or more than that. So it's fine for them. So this is a major point where the trader has to choose what kind of traders you are basically. So here, you can see there are different trading styles. So when you're talking about the trading type of traders here, either trading styles are, we can see a kind of traders like they do trade with technical analysis, some trades with opening and closings, some traders with the pivot points, resistance, supports. Some traders will do with the fundamental news. When the news comes, they jump into the markets and they try to take the points. So it's just odd type of trade. So again, the trader has to have the style, one style, how exactly you're going to trade based on your trading type. For example, you're a day trader, then you choose as per your. So range trading is a strategy where the traders identify overbought and oversold levels. That means with the trader could have overbought, you have to buy at the oversold levels when you have to sell when is the overbought level. That means when the market is a very peak, then you have to looking for the selling side. When the market is a very bottom, you have to look for a buying side. So this is also called reversion to the mean. So it is very profitable when the market is moving sideways without trending, because what happens, many day traders always trying to cash a few pips when the market is a range trading, because the risk are the same, because the support resistance are been very stable, which is a consolidations period. The market in the consolidations, they try to take the points within the range. So it is also one of the major kind of traders who take the opportunities before any news comes. When the news comes, definitely there's a breakout happens on either side, maybe upper side or downside, whatever maybe. So breakout is the price of financial instruments moving outside a defined support resistance or resistance level with a significant volumes. That's what I said. When there is a breakout happen, there's going to be a one-side direction. So this is also a kind of trader. Usually the breakout trader will buy after the price breaks above the resistance and sell the price more the support levels. So these are the kind of styles you implement on the trading. So you have to think yourself, like plan yourself, what kind of trade you want to be based on your money management, based on your trading type, and based on your available time out exactly. So moreover, keep updating yourself about the technicals, what kind of other charts, maybe you're a technical trader, you can look into the technicals, or if you're a fundamental news trader, you always keep update your news basically. See, there are two factors, you know that very well. That's one is the technical, one is the fundamental. But still, they are like two eyes. Definitely you have to monitor, you have to get updated on both the information to get on a proper line to trade on trading styles. So, coming to the next one is money management. Is nothing but a risk management strategy. So, money management is one of the key concepts to the long-term success of any financial markets. Most important thing. Because some traders have a $10,000 and try to jump all the $10,000 into the markets and expect a bigger returns. It happens once or twice, but what happens on a long run, definitely will have a big trouble on your market, on your account. It'll burn your account completely because you take a lot of lots, lot of exposure into that range. So the money management plays a very major important roles after this trading strategy or plans. So it helps to change your trading risk, especially. That's most important thing. Because market is always risk. Without risk, there is no markets or any business, I can say like that. So here, choosing the proper leverage. That's one of the best important point to be notified when you are in risk management. Coming to next is the risk to reward ratio and percentage risk method. Scaling into the trade, even that's a very, very important point because as you trade more, you tend to trade more, you try to get into the market very fast when the markets keep moving it. So that's how exactly the market is. It's like your heartbeat. It keep moving, you try to take more lots inside. And regular checking your trading journals. So let's see one by one, a small information about this. Maybe some may have gone through this thing, but still, a process is a process. Definitely, you have to go through this process to become a successful trader, basically. So let's move on to the choose a proper leverage. Maybe many brokers offer you like more leverages, less leverage, high leverage. That's fine. I agree with you. All depends on how you put lower money to take a high exposure. But still, basically, high leverage means it's high risk. Because you take all your money into the market and you're waiting for the profits. In case the market goes against you, definitely it multiple your loss, multiple your risk basically. So high risk is always, high leverage is always a high risk. When the market favored in the market trade, when the leverage multiple your gains, I said, if a market opposite your trade, however the loss or multiple. So many would have faced this. Someone will be, even it's, I don't mean to say in one instrument, even talking about the multiple instruments. Some will trading on Euro USD, someone will trade on other pound, sterling, someone will be trading on gold, silver, oil, stocks. But still, the entire total amount of your trading account, that is out the hub of your account. So that's the total exposure to be considered from your total balance of your account. So it doesn't mean that you have taken only one lot in Euro USD or one lot in commodity or one in stocks. Doesn't mean that. So anyway, the high exposure, it will always be a high risk for you. So use leverage adequate to your comfortable levels. Make sure that you afford to take that leverage. For example, I can give a small example. For a $10,000 account, okay, I will take a maximum margin of 10%. Okay, that means it's $1,000. So you have your $1,000 margin. So within this 1,000, what leverage you can take? That means, for example, I'll choose like 4 products I want to choose for $1,000. You can choose like 4 kind of instruments, for example, $250 per one per instrument. So you'll have 4 instruments, altogether will be $1,000. So this way you have to plan. So making a plan on the leverage and fixing your leverage is must, because you may think that I can trade with a lower money, lower fund, I can trade a big exposure to make huge profit. But think about the other side. As I said, 10 times you trade, like 9 times you made a profit, but just one entry, a wrong entry, because of exposure, you're wiped out from the markets. When you're wiped out from the market, when you lost your money from your entire money, so obviously, again, back to the trading, we have 2 types of people. One, always think that I will take revenge on the markets. I will take my money back. I will take my money back. That's one. Second type is the fear. You get fear, whether right or wrong, whether I'm doing right or wrong. So this is always there when you not properly followed your leverage, not followed your margins trading. So let's move on to the next. It's a risk-reward ratio. It's a very simple type of concept. It's not much complicated or something. The fundamental idea of this finance relationship is risk and reward. How much risk you take, the returns will be reward for you. So the greater the amount of risk that the investor willing to take, the greater the potential returns, and vice versa, obviously. When you have a high risk, you have high returns. So when you have low risk, the low return. But when many people take low risk, I want high return. Not possible. It's not possible. It's not written anywhere. So always think in a proper way that you are going for the low risk. Obviously, you take for a smaller returns. That's how exactly. So using 1:2, 1:3, 1:5 ratio, risk reward, is always a perfectable. It's based on your balance amount available on your account. Choosing this risk reward ratio is with a support resistance. It's based on your trading style. Okay, I'll choose my reward and risk, especially nothing but risk reward, nothing but the stop loss and targets. So I'll keep my stop loss and support or resistance. I'll keep my targets and support resistance, something like that. So based on that, we can choose your risk. So don't fix on your mind that always I'll take only 2% risk. Always I'll take 1%. But sometimes what happens, some markets gives a value of bigger move on a daily basis. So we have to slightly improve your stop loss or targets based on the support resistance. So avoid trading entry if RR, that means the risk reward ratio is not enough. If your risk reward ratio has not been under your control, under your plan, so try to avoid the particular entries. Next, move on to next. Percentage risk rate method is almost similar to the risk reward method. The percentage risk method is a method according to which your risk is same fraction of your account balance as a percentage of each trade. That means each and every trade, what is the risk you are taking on it? That is not exactly the percentage. For example, I show you some examples here. The account size is $10,000, and if you're ready to take a risk of 2%, the risk of each trade should be $200. If it is a 5%, it's $500. If it is 10%, obviously it will be $1,000. So calculate each position on determining the risk fact based on the account size. Basically, it's based on the account size. From traders, I have $2,000, but they take like a $1,000 risk, 50% risk. Obviously, like you will get problem on your trading. 1 or 2 trades will be success, but the third trade, ongoing trades will be a loser. So again, the same issue will keep coming. You will be changing your mind. You keep changing your method of risk percentage. You change your risk reward. Just keep changing. So these are the process. Definitely have to be adapt to this strictly on your mind that I have to go this way, then only you get a success on your trading. So the number of one risk is known as drawdown. So obviously the amount of money you are lost in your account. That's how exactly is it. Hope this is clear. So I see a small example here where suppose you have a balance of $10,000. The risk of 2%. The example I took here is Euro USD. The risk of this 2% is $200. The each pip of $10 is Euro USD with one lot size, which is a ratio of 1:2 risk ratio. Then your stop loss is 20 pips as far, and you take your profit of 40 pips. That means 20 pips and 40 pips are the profits, double the profits. So in case of failure, you lose only $200. But in case of success, you get $400. So this is how the risk ratios works, and risk percentage of risk ratios works normally. So hence this still the 2% the same 1:2 ratio. Based on the lot size, the risk will be defined. So you can fix on this topic, like fix on your kind of concept, the process in the same way where you try to implement. So never happens. So for example, you keep doing for the 10 times, never matters. Like sometimes 2 times you get failure, or maybe third time you get failure, never matters. But keep doing the same process and keep following the same kind of concept, the process. So you definitely will have a very good output when you've been trading for a monthly or 2 month, couple of months or something like that. So when talking about scale into the trade, that's very important. I've seen many stories. Even myself, I've been learned the scaling into the trading. But scaling into method is a money management, allowing you to limit your potential loss, maximizing your profits, potential profits. Scaling means gradually increase or decreasing the value of a position while trading. I believe. How many are averaging the positions? Most of the people will average your trades, basically, right? When you buy something, unfortunately, the market does not reach your targets. And unfortunately, market has come down your executor positions or the price. You try to attempt to buy back again because you want to take more. You want to take a more higher kind of. So you do averaging. So again, second average, you did it from one point below the level. And again, market go down back again. So you look for, again, the third levels. So you keep doing. That means that you're accumulating your more risk on your trading accounts. So once you started with the one positions, and again, markets come down back, you look into back again, second position, third, fourth, five. So obviously what happens, you are taking a multiple risk on your trading accounts. So here is what you say, this allows to increase your profit if it is a markets on a favor. Fine with that, well and good. Who knows where the market goes, where the market comes. Even your strategy is good, your plan is good, you have a perfect 100% strategy, but your money management is not proper. That means you're losing your control by taking more loss when the markets comes down. So obviously you get a multiple loss. But the market goes above on your direction, obviously you make a big profit. But all the time it will never repeats. It's sometimes markets goes reverse you, sometimes markets against you. So the limit your loss when the markets turns against you. So this is how exactly. Scaling the trade is very important, where how many lots you take on one side, and obviously diversifying your investment and different instrument also very important. So two type of scalings are there, in scaling in and scaling out. Of course, the scaling in is in and out of trade requires a proper money management, a disciplined trading, and sound reasoning. Otherwise, you can lose just like when you're losing with other strategy. So scaling is very important on one of our strategy plan. So make sure that you always proper and a proper lot size, the leverage, everything to be maintained on each and every trade. So coming to the last one, try psychology. So as I said in the beginning, many have very familiar with their trading plans, risk management. They are very good in risk management. I never take more than 1%. I never take 2%. I never take more than 5%. But I have very good trading strategy. I'm very familiar on all technical indicators. I know in and out. I know MS Surya, I know stochastics, I know what are things, I know everything. I know how to come into the market. I know even every time frames trading. I trade in 5 minutes, I trade in 15 minutes, I trade in 4 hours, daily, weekly, whatever maybe. Again, the psychological, it's very important, like human psychology. So everyone would have faced this, each and everyone, including me. I face this also. So your success or failure or trader depends on your emotions. When you're emotionally attached with your trading, sometimes some traders will understand who they are. Doesn't know what they are. When they start trading, they'll understand, oh, I'm very fear person, I'm very scared person. Or sometimes they feel, I'm very greedy person. I'm very greedy. I can come to know myself. So the psychology of the trading gives you a lot of information, lot of kind of person what you are. So here, the success or failure as a trader depends on your emotion. You may have a brilliant trading system, but if you feel arrogant or frightened or upset on your account, you'll be sure be suffer. So there are few things, type of psychological myth I can say. One is reality with fantasy. That means many people start with the demo accounts. Obviously, no one start direct to the live account unless they are Warren Buffett. So they start the demo account and they try to do some trades like a couple of days or week or something, and they made a big profits out of it. They for example, stayed with $10,000 and they made $20,000, $30,000. Then they feel, oh, this is good. The market is good. I can make millions of dollars from this. Let's start with a live account. When they start the live account, then they'll come to know what exactly the market it is, basically. So many people have a fantasy. Oh, I can do this much. I can do this much. In any trading, we can't expect this percentage of returns or thinking about I can make this amount of money by pumping this amount of in my account. Never happens. So we have to come out, understand the reality and fantasy, what exactly the trading says. That's the most important thing. So this is also one of the kind of psychology. And talking about the next brain myth, abuse, they always think that successful traders have some secrets. They have some mantras. They have some kind of magic, something like that. Nothing like that. Because they are following a proper process, following proper management systems, money management. So these all brain myth. They look into some people and this guy is making a lot of money. But why can't me? Something is doing. No, there's no any magic inside. All the same markets, same systems, same thing happening. So these also have to come out from your mind by keeping a psychological factors which really eat your mind while the time of trading. So next is it undercapitalization myth. Obviously. And again, some traders will feel the failures. Basically, the failures traders always think about, I have only $100 account. I have only $500 account. But the guy who made a lot of money, he has $10,000 account, $50,000 account, $100,000 account, or $1 million account. So this is himself making himself a myth, saying that, considering himself that I have a lower size account. No, not at all. Even a smaller size, I don't mean that smaller size will make it to $1 million, but same time, the smaller size give you the successful trader for you. Even you trade for 2 months or 3 months or 5 months with a smaller amount, that if you are success, definitely you are made to make a bigger size. So, uncapitalization myth also one of the biggest factor where you also think that let's start the bigger money. Yeah, because small money, I didn't make anything. Maybe I'll lose my $100 or $500, $1,000, whatever it may be. Let's start with the bigger money, like $10,000. No, again, wrong. He's doing it wrong. Because without any plan, without any risk management, he's again jumping into the market with the bigger size. Because revenge. He's taking revenge on the markets. I'll take revenge. Let me take back my money. So again, a psychological comes out in your mind saying that, let me put on this. So this is also one of the myths, keep to avoid when it's going for a trading. Bending the rules, same. Everyone do initially, because unless you become an experienced trader, mostly the beginners traders always suffer this thing because they start following some informations, the own information, or maybe they follow with some other outsourced informations. Okay, buy here, sell here. This is my resistance level. This is my support level today. Let me buy. A lot of information, because nowadays the sources it's humorous. Like you can get a lot of information from your Google search. So they keep doing it. But what happened? Like they change after a week because they see that no, it's not a good strategy. They are doing something wrong. They're not good. Let me go with another type of trading style. You follow that. Again, after 2 days after, you go for the third one. Again, fourth, fifth. Just keep going. And it never ends because it jumps like, I do this. Like, at the end of the day, it completely come out with a negative balance on his account. So again, bending the rules also one of the major psychological factors where any traders will face or any traders will come across in their trading. And last, not the not least, it's emotion trading. As I said, everyone is combined with that. The fear, your fear or the greediness, the upset or something like that. That's the most important thing. It will affect your trades. Any traders, you have to be a peace of mind and you are strong on your trading, on your risk management. Psychology is nothing. Psychology is nothing about the trading. So forget about the psychology, because then if you don't have a proper strategy or plan, then your lot of doubts comes on your mind. Right, I'm not a proper. I have something problem on my plan. So I may get profit or not lose my amount. So each and every trade it comes into your mind. And most of the traders I've seen, they are, as I said in the beginning, like many traders have been trading for a day trade. But as they push into the next day, they became a position traders, maybe for a weekly or monthly. A small trade, they expect for 10 pips, but they waited for more than 200, 300 pips against them, and they became a position traders, basically. So what happens here? Emotionally, that they change, bending the rules out of it. The fear will comes into the mind. And obviously, like they are always into the situation that whether I'll come out from these markets, whether I'll do further. So a lot of a plan disturbance will be there in this completely when you not have a proper process. So that's it. So if you see that, basically, these are the process, basically, 1, 2, 3, which is a trading strategy. I can say a money management or risk management, or I can say yeah, trading psychology. Hope you all enjoyed. Any questions, anything, you can always.
The high leverage is safe for me to trade or no? Yeah, I'm always looking for leverage of 400, 500.
No, obviously. Even for the, I've seen the real experience in my experience, in my trading experience or my clients' experience trading. Obviously, wherever the trade high leverage, basically, it's completely a high risk for them. Maybe some people have comfortable on the trading, but general talk, going with high leverage, you will have high risk. As I said, you have more exposure into the markets. That means you take a lot of entries, a lot of positions into the markets. So you don't ever know how the markets moves. Any news comes, any type of news can just react the market. One side, if you're a speculator, then it's fine because you think, oh, market's going on my favor. But again, if it is the against side or the opposite side of that, it definitely it burns your account. So always go in a reasonable kind of leverage. Maybe a beginner always advised to start with 1:50 or 100. When you educated yourself, knowledge about yourself in the markets, slightly improve to 150 to 200. So 200 is always a perfect and reasonable and advisable kind of leverage always into the tick. Minimize your risk on this. Yes, please.
You said there is the difference between the trading strategies, which is a scalper, day trader, or position. Let's assume I am a day trader, and I took a position with 50 take profit, 30 stop loss. But during this day, it did not close. It didn't reach either. So it keeps on going for the second or third day. This is an example. What do? Do you close it with the current situation or keep on to reach the either or the profit or the stop? Thank you.
Perfect. It's a good questions. As a day trader, normally what I do, I'm already a day trader basically. From the name itself, I'm a day trader. So I'm not supposed to take it to the next day, basically. So when you open the trade in the morning and you waited for all night after the US markets, still your profit has not been reached completely. And maybe two options are there here. Either you'll have small profits, maybe you have a small loss, obviously, because you're not booked your loss or profits. It's completely, as a day trader, I advise to close your positions and go back to the next trade of the next position. Because, why I say, every day market has a different news. And obviously, when the market closes and opens, it's around the clock. It starts with the New Zealand, starts with Japanese markets, Chinese markets, Europe, London, US. So, in the point of time, when the market opens back, it may come with a new news because you will be watching a one position all night without your sleep. Again, without sleep, that will damage your entire day, next day. And you again will be in trouble of keeping open your eyes for just for one positions. But still, you are safe on the both the side. That means you have kept your target, you kept your stop loss. But still, you're never able to sleep yourself. What happened? But happily, you see the profit, close your positions, go for the next trading station day, start the new trade. Because you are a day trader. You don't want to take your position for the next day. Thank you.
Yeah, hi. You spoke about positive RR. What about your take on negative RR,
It's positive?
return to ratio.
Okay.
Yeah, you spoke about positive. What about the negative RR?
Same. Like if you're talking about you're talking about the risk reward ratio, right?
Yeah, right.
Same. As I said, like I showed the example of $10,000, which is like 2% your
No,
risk factors.
Sorry, like you are saying, like it has to be 1:2,
Yeah.
right? So my take is, if I am risking 2:1,
2:1.
yeah. So
Okay.
I'll risk 2 to make 1.
Exactly.
So what is your take on that?
Are you a beginner or you're an experienced trader?
I'm trading from past couple of years.
Okay, okay. So those kind of thinking, or why I'm asked this thing is that the experienced trader also have this kind of mind, because they've seen many kind of trading activities, trading kind of experience they have. So obviously, when you do with the 2:1 ratio, it works. But unless you have a proper strategy with you.
No, if I have a higher win rate,
Okay.
suppose if I have a 80% win rate,
Okay.
and if I do 2
Why
to
not?
1,
Why
3
not?
to 1,
Why not? 80% is a bigger return, sir.
Yeah.
Very big performance, actually.
so what you can like say is like if the win rate is more, can we go for a negative RR?
Definitely.
Okay, thank you.
Definitely. Because you say the 80%. It's
Yeah,
mind
like
blowing, actually.
Anything above 65%,
Perfect.
If it is there,
Perfect.
I go for 2
You
is
can
to
try
1,
anything.
3:1.
Any
yeah.
risk ratio, because you know your risk now.
Yeah,
Obviously, you are an experienced trader. You know the risk, what risk you are taking. So taking out your ratios are not a matters, actually.
Okay, right. Thank you.
Hi, how are you?
Hi, good. Thank you.
You as a day trader, do you sit and watch the market the whole day from the open to close, or do you have particular times where you would, those are your best times to trade, or do you have any alerts set up or anything like that? What would you recommend as
That's
a day
good.
trader?
That's good. Because many traders keep watching the market from the morning to evening. So that is also a bad myth. It's one of the psychological myth. They keep watching. First time, maybe they have some plan on the trading. For example, you people have familiar with the technicals. They look into the technicals. Okay, for example, MACD or take about something or indicators, buy and sell. They miss a chance one time, two times, third, fourth, fifth. Finally, they take the chance. The market goes reverse to them. So problem is that you keep watching the markets continuously without non-stop, but doesn't know what to do. What has to do for that? So keeping watching a markets continuously for all day, I advise you, it's not good actually. It's not a healthy kind of trading, because you get stress because you see the markets. Suppose you follow only one instrument, well and good, not much pain for you, or no kind of brain pain for you. But when you're following with number of instruments, for example, you follow currencies, you follow commodities, current stocks or indexes. What happens? You keep watching, then you correlate to yourself. Okay, market is moving because of the US market open and the Dow Jones keep moving, so the currency is down. So you yourself correlated yourself. But none of the market has that kind of things. Because currency is different, maybe some impact will be there, but there's no such correlations are not seen most of the times. So watching the markets continually for a full day, all day as a day trader, I'm not comfortable to advise to watch on it. Take your time, maybe you're a business person or maybe you're kind of a working person. Make yourself you're free for the market for at least for a couple of hours or 3 hours maximum. Spend only time for that, because what happens when you focus on one particular time frame, you more focus on it. You try to learn about the markets and try to learn something more about the information, about the knowledge you get out of the markets. So that makes more sense when you're fixing your time as a day trader. Thank you. So that's for today. Hope you all enjoy. Thank you so much. Thank you.